All right, good morning. My name is Owen Kiernan, and this is for the CFP Course 107, the case study of Jeff and Nancy Arnett. Now, today I'm going to be communicating my evaluations and recommendations for the education portion of the case study. I'm just going to go in order as the questions arise, or arose rather, in the actual case study and go from there. So the first question we get is from Ryan. Ryan is Jeff's adult son from his previous marriage to his ex-wife Susan. Ryan's 23 years old, lives independently above the laundromat, and has been working at the laundromat for the past 5 years with his dad. He goes to college part-time in the evenings as well. Now, the last time that I was at the laundromat, I sat down with Ryan. He had a few specific questions, and he wanted to know, can he deduct his part-time college expenses, and what information would I need in order to provide him a recommendation. There's a lot of great things out there to help with part-time or full-time college expenses. Whether it's savings accounts, whether it's deductions, tax credits, scholarships, but I'm unable to provide Ryan a recommendation because we don't have a client-planner relationship. So first and foremost, we would need to really discuss and define what that relationship is going to be. And then we're going to need to follow the rest of the financial planning process in order to provide him with a recommendation and really a financial plan. Ryan did ask, what information would I need in order to provide him a recommendation? And that is really, it's the second step of the financial planning process. So I would share with them, what we would need in order to, make recommendations. Is really understanding what your goals are, and this is it all includes, but it's not limited to these things. But W-2, prior year tax returns, bank statements, stuff like that. Any information that he can provide that will give me context around his current financial situation, that is going to be helpful because that's the information I can use in order to provide him a very detailed and effective financial plan. The second question that we get comes from Jeff. Jeff, he wants to help his daughter Ashley. It's his 12-year-old daughter from his previous marriage to his ex-wife Susan. He wants to help Ashley with her future college expenses and would like to do so from his discretionary income. He wants to see the projected annual cost for each of the 4 years of college for Ashley. So what I did was I went online and I looked at the College Board. The College Board had the average costs of tuition for private, non-resident public, and state resident public college. For the video, we'll use here the non-resident public college, which is $23,893. And we're going to assume that Ashley's going to attend college in 6 years, since she's 12 years old. And the cost of college will inflate 6% every year. So we look to find the future value, which is the first year of college, and that's going to be $33,892. The second year is going to be $35,926. Third year is going to be $38,081. And the fourth year is going to be $40,366 for a total of $148,267. Based on the needs and goals of the Arnetts, Jeff doesn't really have the discretionary income to help Ashley with her overall education expenses. So what I would suggest is that he open a 529 in her name and really contribute up to and through her college or 4 years of college. 529s, they can be reassigned if there's any leftover money, and I know he's trying to save or help save for Jeff Jr. and Emma, their college education. So that could be helpful in that circumstance. The other options that I did consider, were a Coverdell and an Agma Ugma. I'll get into the differences between these accounts in one of the later questions, but just to give you somewhat of an explanation, the Coverdell has a $2,000 limit. It does have it is very similar to a 529, but in the grand scheme of things, it does have a $2,000 limit. So maybe Jeff comes into some money. He's got some extra discretionary income. Maybe somebody else wants to help him contribute, so on and so forth. And then the Ugma, that's more for a transfer of assets, and there's no special benefit to using it for college expenses. So the The next question comes from Jeff and Nancy. They want to help their kids, Jeff Jr. and Emma, save for college. They want to know what the annual savings should be in order to provide them with $25,000 each for each year of college in today's dollars. So Jeff Jr. and Emma, they're 4 years old. We'll assume that they're going to attend college in 14 years. The cost of college, the tuition will inflate by 6% every year, and the assumed rate of return is going to be 10%. So what we do is we find the net present value, and then we use that to find the payments. So in order for Jeff and Nancy to provide Jeff Jr. and Emma $25,000 each in today's dollars for all 4 years of college, Jeff and Nancy will need to save a total of $15,311.45 each year until they attend college. The last question that we have here for the education segment comes from Nancy. Bob and Darla, her parents, they want her to establish a savings account into which that they can commingle funds for Jeff Jr. and Emma's future education expenses. So Nancy came to me and she asked me what I thought, what I felt about the idea, and what are her options. I might be nitpicking, but I think it's important that we know this ahead of time. Nancy's parents, they didn't specifically say college education expenses, whereas Jeff and Nancy made that well known that they want to specifically save for college. That's going to affect the recommendation. Coverdell you can use for K through 12. So I think it's important that we figure out first and foremost if they're on the same page with that. So I'm going to refrain from a recommendation and more so provide information around the options. Overall, I do believe that Bob and Darla contributing to Jeff Jr. and Emma's education is great. The few different savings accounts and education savings accounts that are helpful and applicable in this situation, they have to be used for the beneficiary. So I don't think the commingling of funds will be an issue. But anyway, the 529 is a great option. It's only allowed to be used for college expenses. There's no annual contribution limit. The account grows tax-free, and withdrawals are tax-free as well if they're used for qualified expenses. The beneficiary, as I had mentioned before, it can be changed. It can be reassigned. And then the assets in the 529, they're considered to be the parent's assets, so that is helpful when applying for financial aid. Coverdell is very similar, except it does have a $2,000 contribution limit each year. It can be used for K through 12 qualified education expenses as well as college. It does have to be fully withdrawn by the time the beneficiary reaches the age of 30. And just like the 529, the assets in the account are considered to be the custodians, and therefore doesn't really, it's not heavily weighted against them when they apply for financial aid. Now lastly, the UGMA. As I mentioned, it's more so for a transfer of assets because there's no benefit really for using the funds for education. One of the important distinctions, though, as well, is that the funds in the account, they're considered to be the beneficiaries. So if you were to apply for financial aid, it would be counted against you, more so than, say, the 529 or the Coverdell. And the UGMA, that does need to be transferred to the minor at the age of majority. So that concludes the education portion of the case study. Those are my evaluations and recommendations. I appreciate you listening to this little video, and appreciate all consideration going forward in grading this. Thank you for your time.